Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
The elephant in the room around the corner is Brexit. Now, you say your projections are based on a relatively smooth transition. Do you have a set of figures for a disorderly cliff edge Brexit sitting in the cupboard? And can we see those?
The way we make policy is around the economy as it is and how businesses and households are behaving. So UK households are broadly consuming out of real income growth. There is not a sharp increase in savings. There's not a sharp fall in confidence that would be consistent with a disorderly cliff edge Brexit at this. So that's what's happening in the economy. In the event that there is a different Brexit outcome, you use the example of a cliff edge disorderly Brexit outcome. If there were that situation, we would adjust policy.
What would happen to the economy?
I think the clue is in the adjectives. Disorderly, cliff edge. It would not be a positive result for the economy. Today, the right call is to make this modest adjustment. If there's a big change by the end of the year in terms of our relationship with Europe, if it's a WTO relationship, we'll take that into account and we'll adjust.
You can cut it again, basically. I mean, so you loaded the gun, so you can cut it again.
No, that is not what we're doing. We are not creating ammunition for some future. This is because the path the economy is on, that some adjustment of policy is appropriate. In order to, as I say, people are starting to get ahead. The way you help that continue is to make sure that inflation goes back to that 2% target and stays there.
You're being quite cautious about what you're saying about Brexit, and I understand that. Is it because you feel stung by, a lot of people have been attacking you. A lot of the Brexiteers have been attacking you as part of Project Fear or the designer of Project Fear. I mean, did you feel that you got anything wrong, and is that why you're being quite cautious about what you're saying about Brexit now?
No, look, what we said prior to the referendum is that we felt that if the vote were to leave, that the pound would go down sharply, that inflation would rise above target and the economy would slow. Well, guess what happened? The pound went down 10% after, down 17% on a sort of undisturbed basis. Inflation's been above target since effectively the referendum. It's now just being brought back. And we've gone from the fastest to the growing economy in the G7 to the slowest growing economy in the G7. So what we said has come to pass. The other responsibility we have is to make sure the financial system is ready for whatever could happen. And that requires telling some hard truths about what the real risks are in the financial sector. It involves making banks carry enough capital and other buffers in order to be there. And we make no apologies for that. And people can put whatever labels they want on that. It might not be popular, but it's what I think people expect of us, and we'll continue to do that.
Governor, thank you very much.
Thank you.
On Brexit, are you putting rates up just to give you a bit of leeway to cut them again if there is a really difficult crash landing next March once we've left the EU?
No, we're not. We're putting them up. We put them up because it's the right thing for the economy on the path that the economy is on, and it's a modest adjustment. It keeps the economy on track, increases the prospects that people will continue to get ahead. Their wages will grow faster than prices in the shops. An important thing to recognize, I think we all recognize that there is a very broad range of potential outcomes to these Brexit negotiations, and we're entering a critical phase. For a number of those outcomes, possible outcomes, interest rates, in our judgment, should be around current levels or potentially higher. There are other scenarios where interest rates might need to be cut, but it depends on what actually happens. Let's see how the negotiations culminate and what the transition is to that new end state.
Jeremy Hunt said this week that he's worried the UK will slip into a no deal by accident. Do you share that concern?
I think the possibility of a no deal is uncomfortably high at this point, yes.
Uncomfortably high?
Yeah, our responsibility, and now I'm moving from the bit of the bank that is responsible for interest rates to the other bit, which is responsible for the financial system. So A moment ago, I gave you a glass half full interpretation of where competition should go in banking. This other half of the bank is entirely glass half empty all the time. And so our job...
There is no hope.
So our job is to look at what could go wrong, what are the bad outcomes that could happen, and what can we do to make sure the financial system is in a robust position so that it lessens the impact of a bad deal in this case, a no deal Brexit. And what we have done, and I think it's important to underscore this, is we have made sure that the banks have the capital that they need, have the liquidity that they need, and that we have the contingency plans in place so that if there were to be a no-deal Brexit, and not just a no-deal Brexit, but a no-deal Brexit without any transition, so something that truly is by accident, because it's absolutely in the interest of the European Union and the United Kingdom to have a transition to whatever deal.
Right, so you're saying quite clearly that a no-deal Brexit would be a disaster.
It is highly undesirable.
Disaster?
Parties should do all things to avoid it.
All right. What is the worst thing in terms that people can understand who are not entirely au fait with all the language that economists use? In practical terms, what does that mean to people listening to this program now? You say highly undesirable, and for a banker, that's pretty strong language. That's almost verging on the lurid. What does it actually mean for people?
Well, there's a variety of things, and we heard a moment in your news bulletin about the contingency plans of various businesses, whether they're selling goods, selling foods, pharmaceuticals, or manufacturing any of those products, that only about a third of them have contingency plans, proper contingency plans, and even those are not fully enacted. So it does mean potential disruption. Certainly it does mean disruption to trade as we know it. And as a consequence of that, a disruption to the level of economic activity, changes higher prices for a period of time. Now, our job at the Bank of England is to make sure that those issues don't happen in the financial system so that people will have things to worry about in a no-deal Brexit, which is still a relatively unlikely possibility, but it is a possibility. But what we don't want to have is people worrying about their money in the bank, whether or not they can get a loan from the bank, whether it's for a mortgage or for a business idea. And we have put the banks through the ringer well in advance of this to make sure that they have the capital. Oh, absolutely. So let me give you an example, if I may.
In case of a run on the bank, is what you're saying?
Well, the exact opposite, which is to make sure the banks are there to lend to the economy, to provide, to advance, not retreat.
So you think we might be in that situation?
No. We won't be in that situation. We will not be in that situation. With respect to the financial system, the UK financial system has tripled the amount of capital they had over the course of the last several years. They have increased the amount of liquidity, the money they have on a day-to-day basis, by 10 times over the course of the last several years. And the reason they've done that is to be in a position to be able to withstand a shock. Wherever the shock comes from, it could come from China, it could come from abroad, it could come from a no-deal Brexit. And we have meticulously gone through the types of risks that are associated with a no-deal Brexit to make sure the institutions are in a position.
So is this...
Now, there are, if I may, John, there are a few things that the banks, just having capital and having liquidity, they can't solve for. There are a few issues that cut across borders that the UK government and the European Union governments have to solve. The UK government has taken virtually all the steps it needs to. It has one bit of legislation, secondary legislation it needs to table, but it's prepared and it intends to table in the autumn. So the UK government has done everything it needs to. The European authorities still have some steps to take. We're in direct conversations with them about it through the Bank of England, the ECB, the Treasury, and the Commission, and we would expect those to be addressed.
So in other words, if next March there is no deal, therefore there is no transition period, these plans, if I can use that expression, they will swing into action.
Yeah,
in other words, it'll be a bit like the financial equivalent of the military being put on standby to make sure there's food in the supermarket.
Well, it's not a perfect analogy because we've already done the stockpiling. The banks have already stockpiled.
But it's not a million miles out.
Well, the point being that the financial system will be ready for that undesirable and still unlikely possibility. The financial system will be ready. We ran the system a year ago through a stress test, which had, and this is not the prediction for what would happen in a no-deal scenario, but to give you an idea of what they can withstand. Real estate prices going down by more than a third, house prices and commercial real estate. Interest rates going up by almost 4 percentage points. We just raised them a quarter percentage point. Unemployment going to 9%, and the economy going into a 4% recession. Now, we did that in order to create the kind of hits to their balance sheets and the calls on their capital and liquidity that meant they had to build these buffers to be in a position in case something bad.
So you've been sitting there planning for Armageddon.
We have been planning for very difficult circumstances, and the banks are ready.
But you did say, what, 2 years ago, you warned that the economy faced a material slowdown if we voted to leave the European Union. We could even see the UK, you said, slip into technical recession, and you were wrong.
No,
I mean, you might know about this.
No, we were. I would say we were bang on because we said
well, we haven't had a recession.
Well, we didn't have a recession. We cut interest rates and we bought $70 billion of assets and we put in place a $125 billion facility to make sure those interest rate cuts were passed on. That's what we did in the immediate aftermath of the recession. Despite having done that, and despite the fact that the global economy picked up by almost a third over that period of time, the UK economy, unfortunately, has grown by less than by a percentage point less up until the spring of this year than we had projected prior to the referendum. And when you adjust for the stimulus we've given, the stimulus the government has given, and the strength of the global economy, it's about 1 3/4 or 2 percentage points lower than it otherwise would have been. That's our projection on projection estimate. That is a big difference. So we've gone from the fastest to the slowest growing in the G7. We've had a big shift in sterling, 17 percentage point shift in sterling, and we went through 2016, the latter half of 2016 and last year with a real pay squeeze on British households, which we're just getting out of.
But what you're saying is, compared with that, what we would see if we crashed out of the EU is that was child's play compared with what could await us.
What I'm saying is that we have prepared the financial institutions, the banks, for very difficult circumstances in order.
We need a long transition.
But in order to make sure that they're in a position to lessen the impact.
And you're saying we do need a long transition.
Yes, we should have a transition. It's in every industry's interest. It's in every citizen's interest. Well,
talking about 2 years. Should it be longer than that?
Well, it should be. We'll take the 2 years.
Is that enough? Would you like it to be longer?
We'll make it enough.
We'll
make it enough.
Would you like
we'll
it
make
to be
it enough? It's there are many other things to be negotiated, and we shouldn't add it to the pile.
On that note, Mark Carney, thank you very much.
Thank you, John.
And Dominic's been sitting there listening to all of that. Go on.
Well, the MPC, the Bank of England Monetary Policy Committee, voted 9-0 yesterday for a rate rise, which made some people think that actually there are more rate rises on the cards. But the governor of the Bank of England has pretty much put paid to that. He said 1.5%, perhaps over 3 years we might get to 1.5%. And at 5%, which is the sort of the normal rate, is not around for the foreseeable future. The other thing I took out of it was a very robust defence of the Bank of England's predictions for the economy after the Brexit referendum. Been a lot of criticism of what the bank said, but he said actually we're nearly 2% less. GDP is nearly 2% less than what it would have been without the Brexit referendum.
And all that planning for financial Armageddon if we crashed out.
Well, banks do have a lot of capital, which is why RBS is paying that dividend. And he's right, the stress tests have been done. They were done for that. Banks do have a lot of capital and liquidity. But when you plan for shocks, it's never the shock you plan for that arrives.
Tom, thank you very much.